Hello, everybody. Ed Yardeni here, and Max is over there doing what he typically does during my calls, having a good sleep. As you can see, it's a very bright day here. In the background, I have a sliding glass door over there with some curtains that don't really block things out, but that's all right. Um, at any rate, I hope you all had a good weekend. And now here we are starting a new week. Happy Columbus Day. The bond market is closed. I thought that would actually be a good relief to have the bond market closed for a day here. But actually, it seems like the bond market's doing okay. The war in the Middle East that broke out on Saturday seems to have created a flight to quality. At least that's what I'm seeing here in the TLT. That's the Treasury ETF. And then there's something called MUB, which is a equity that tracks the municipal bond market quite well. And both of those are actually up, suggesting that if the bond market was open, the bond yield would be down somewhat. But if that's the case, it's clearly down on some very bad news out of the Middle East. I'm kind of torn here, partly because honestly, I've got relatives up in the north of Israel. I was born in Haifa, so that's where I was born, and the relatives are very concerned about the war spreading to the north, with Hezbollah starting to launch missiles or try to send terrorists across the way. But anyways, I'm trying to stay calm here and focus on what we need to focus on today. The reality is that this war, like all wars, is very unpredictable. I think the knee-jerk reaction so far, see in the stock market, is fairly calm. We see the crude oil price up $3-4, and the stock market's down a bit, not much. I think it's we're all going to be concluding, as I concluded in my quick takes on over the weekend, is that this should be another one of those short conflicts between the Israelis and Hamas, and that there'll be a lot of pressure on both sides to come to a quick ceasefire, and life will go on without too many repercussions from the latest conflict. However, the taking of hostages, the killing of civilians, that's a whole different war here. And Bibi Netanyahu declared that it's a war; it's not an operation. And the goal of the Israelis is one to deal with what now is clearly an existential threat, and that's to eliminate Hamas. That's not going to be easy, as Netanyahu said, simply because Gaza is a very small strip of land with 2 million people, very crowded. It's hard not to do collateral damage. Actually, there's no way that there can't be collateral damage. And on top of all that, the terrorists have Israeli hostages, which will undoubtedly be used as human shields, and undoubtedly will be used in efforts to try to get an exchange of the hostages for all Palestinian prisoners on the Israeli side. So it's a potentially very ugly situation, and I'm kind of viewing this as a war between Israel and Iran. I mean, let's face it, Hamas is a surrogate for the Iranians, Hezbollah is a surrogate for the Iranians. My concern, like my relatives, who obviously have a much greater concern than I have, is that the Hezbollah starts launching missiles and opens up a second front. It's not kind of clear the extent to which Iran views this as the beginning of their attempt to wipe out Israel. But they said that's what they want to do. And meanwhile, this is in some ways existential for the Iranian mullahs. Why is that? Well, there's been a lot of discontent at home, especially with regards to the way they treat women and treat everybody as an authoritarian regime. And so this is what authoritarian regimes tend to do when things don't go well domestically. They start wars. And so there is a potential for this thing to become a much more serious situation. From a military perspective, Israel's surrounded by Gaza, it's surrounded by, and Hamas in Gaza, it's surrounded by the Hezbollah in Lebanon. And then apparently the Iranians have some forces that they've basically lodged in Syria. So it's not clear how Israel can retaliate against Iran, but clearly the Israelis have made plans for this kind of eventuality, a multi-front war uh, propagated by the Iranians. Maybe even if it gets to be that widespread, maybe it won't have much impact on the price of oil. I think clearly the Biden administration is going to have to be a lot tougher on the sanctions than they have been with Iran. They've been kind of easing off on the sanctions. If that's the case, then maybe that'll really reduce Iran's ability to export oil. On the other hand, the Saudis would probably pump it up. The Saudis, in a perfect world, would like to see the price of oil at 100, in my humble opinion. But I think what they've learned in the past few days is that 100 isn't going to work because what you get is demand destruction. We've seen gasoline demand in the U.S. come down rather sharply in the past few weeks, with the price of increase of oil up 33% or so during the third quarter. So the Saudis are getting a lesson from the real world economy that 100 isn't going to work. And so I think they recognize that if things really get ugly here and in the war, and one of the repercussions is the price of oil spikes up because of a shortage of whatever oil Iran was putting into the marketplace. I think the Saudis recognize that they're going to have to pump up the price, pump up their production to get the price back down, whatever spike might be over 100, and get it back down to something that American consumers and others can live with, which is probably something more like in the 75 to $85 level to bring the pump price down. So there's a lot of moving parts here. I'm probably going to be raising my risks of a U.S. recession a bit, um, given this development, and given my view that this is not the typical confrontation between Hamas and Israel that will, in a few days, end up in a ceasefire and all will be well for until the next confrontation. This one isn't going to go away that easily. Well, now that we've kind of focused on what's been going wrong here, let's focus on what's been going right. And in the morning briefing, let me get you the charts on that. Uh, See if they'll show up here. Yep, here they are. So today is October 9th, and this is the morning briefing charts for this morning's briefing and the advanced copy that you all get the day before. I figure give you some quality time to study them if you need to. Otherwise, you can see them in the morning and do a quick read of that. But the focus here is on the consumers, and the consumers look like they're going to be hotter for longer. It's an interesting development because people have been pessimists have been saying that this is about the time when consumers were going to hunker down and start retrenching. Why is that? Well, the theory was that they piled into a lot of excess saving during the lockdowns, and then with the helicopter money that was dropped by the Treasury, 3 rounds of checks to millions of Americans, and that they didn't spend it all right away. It piled up as excess saving. And since then, in the past year and a half, 2 years, consumers have been spending that excess savings, and they're about to run out of it. And suddenly they have no choice but to retrench because they just don't have the income. Well, I've been arguing that I don't buy that argument. For one thing, my demographic cohort, the baby boomers, 75 million of us, increasingly are retiring, and they have the wherewithal in terms of their their retirement savings, to do a lot of spending. There is an article in the Wall Street Journal, quotes me because I talked to the reporter, and I think I gave her the ID. but there's a lengthy article in the Wall Street Journal about how seniors are living pretty well on their retirement assets. They have obviously no more kids to send to college. Their houses have low mortgages, if any mortgages, and they've realized that they've gotten to the point where they now have to deal with what they do during retirement. And what was the point of saving all that money for retirement other than spending it? But of course, there's a lot of choices, decisions to be made here. How much do you want to leave the kids? How long are you going to live? How healthy are you going to be? So that doesn't mean they just kind of go on a spending binge and spend everything. I mean, if somebody told us exactly that, we're all going to live to 100 and we're going to be healthy, that leads to one sort of consumption pattern. Whereas if we're tipped off that we're going to live until we're 75 and going to be miserably unhealthy, that's a whole different kind of story. Though it could still lead to more spending on healthcare rather than on traveling and restaurants and the like. Anyways, I wish you all what Spock once said, which is live long and prosper. By the way, speaking of Spock and live long and prosper, in my book on In Praise of Profits, I pointed out that one of the reasons there's wealth inequality in the country is because of the baby boomers. The baby boomers have been living long and prospering. And when you live long, your assets compound, you save more, it accumulates. And a lot of the wealth inequality is simply because older people are wealthier than younger people. So just kind of a side note here. But on Friday we got some good news. I was listening to CNBC in the morning, and Becky Quick said something that I thought was pretty clever and optimistic, so I liked it. Um, and that was maybe what's happening here is that people have run out of their excess savings, but instead of retrenching, they're going to work, and in order to get some income, and that might explain why the participation rate in the labor force has gone up, and why the employment numbers are so strong, even though wage inflation seems to be moderating. I like that theory, but the bottom line is there's still plenty of job openings. There's still lots of people getting jobs, and so that really has always been the source of purchasing power and therefore of spending. Excess savings is a fairly unique phenomenon related to the pandemic. In the past, what it would take to get the consumers to retrench is for them to lose jobs, not gain jobs. And so it's hard to see how you get a consumer-led recession when employment is so strong. And by the way, speaking of the demographics, I've said before that I think one of the reasons that the labor market's so strong is because the areas where we're seeing the most strength and record high employment is exactly in the areas where retiring the baby boomer consumers are spending. They're going out to restaurants more, so we need a lot more hospitality and leisure and hospitality workers. What else are they doing? They're getting older, so they're monitoring their health more closely. So they're using healthcare providers more, hospitals and doctors. So employment is at an all-time record high in the healthcare industry. The construction industry is at an all-time record high. I don't know that I can make a baby boomer story out of that. I think a lot of that has to do with a rolling recession. We've had a rolling recession in single-family housing. Multifamily has been doing very, very well. And then, of course, we've had onshoring, so manufacturing facilities have been built. And then the government's going to be spending more on infrastructure. So that's an area of strength. So there's a lot of different plausible reasons for why the labor market has been strong. And if the labor market is strong, I don't think we're going to lose the consumer. Well, the consumers, the arithmetic of the consumer is pretty straightforward when we look at the numbers. First, we're starting off here with consumer optimism, which is a index that Debbie and I construct simply by averaging the consumer sentiment index and the consumer confidence index. We find that the consumer confidence index is more sensitive to the labor market situation than is the consumer sentiment index, which tends to be more sensitive to inflation. So why not average them and see what kind of this grand survey looks like? And you can see that we've had a nice recovery here in the consumer optimism index. It took a little dip here in September. Maybe that's the effect of gasoline prices going up, causing a dip in the consumer sentiment index. We're still at levels. See if you just kind of take an eyeball here. We're still kind of a relatively low level. This one preceded this recession. This one was sort of in that recession preceded. So it's still a relatively low reading. Consumers aren't exactly wildly optimistic or happy. This is the current conditions. The current conditions are better than the expected conditions. You can see the expected conditions are still quite depressed. The current conditions have rebounded quite a bit. During last year, obviously, they took a dive with the inflation and with the war in Ukraine and interest rates going up, but they've rebounded somewhat this year. The misery index is down a lot. The misery index is simply the sum of the CPI inflation rate. So the CPI inflation rate is, I think, is turning out to be transitory. We'll take another reading of that on Thursday, but excluding shelter, the CPI headline rate is 2% on a year-over-year basis. The CPI core rate, excluding shelter, is 2.2%. I mean, we're at the Fed's 2% inflation target, but for shelter, and shelter inflation is coming down sharply. If you look at Zillow and Apartment List, as I've been saying for quite some time, and that's, I think, going to start showing up an important way in coming months. So that's helping. And that's all happening without a recession. Could it possibly be that a lot of this inflation turned out to be transitory after all and was in fact related to the shock of the pandemic, particularly on supply chain disruptions and the like? Of course, there's a counter to all that, which is labor is more aggressive in demanding higher wages, and maybe labor costs are going to go up, and suddenly there'll be sort of a second wage price rent spiral up ahead here. That's not my story, but there's certainly developments along that to give that story some credibility. Meanwhile, the unemployment rate remains at historical lows. Now, the pessimist will say it's always low before recessions, and my response to that is, well, as long as employment's growing, the unemployment rate is going to stay down, and there's not going to be at least a consumer-led recession. And I don't know how you get a recession without a consumer-led recession when we've already had a recession in single-family housing, when we've already had a recession in retailing, which is consumer-related, and yet we survived that. And now there's evidence that the goods recession, the retailing recession, at least is bottoming. Meanwhile, whenever the employment numbers come out at the beginning of every month, we immediately calculate our earned income proxy, which is what's the average work week, how many people are working. So that's aggregate hours worked in billions, and then multiply that by average hourly earnings, wages. And as you can see, that continued to move in September to a new record high in current dollars. It's conceivable that we know that inflation's eroding some of that, but even in real dollars, it's likely to be at an all-time record high. And just to show how important it is highly correlated with wages and salaries in the private industries in personal income. This is actually the way the Bureau of Economic Analysis projects or estimates personal income. Here's that aggregate hours worked in billions, all-time record high. Again, these are basically coincident indicators. Leading indicators have been pointing to a recession since they peaked back in December of 2021. That's meanwhile, the coincident indicators keep making new highs. Payroll employment is one of the four coincident indicators. This isn't a coincident indicator, but it reflects payroll employment and the number of hours worked. And the number of hours worked, by the way, is a leading indicator. I don't want to get too complicated here. So this is the average work week. That's, during the pandemic, people were working longer hours because some of their co-workers decided to stay home and not go to work. And now we're kind of back to normal on the length of the work week. In a recession, you typically see it taking a dive, and so far that's just not happening. The revisions were good. If you're rooting for the economy to do well and for labor to get for workers to get jobs, we had upward revisions of about 100,000 in July and August to payrolls. So that's a healthy development. Let's move on here. So here's that period of excess savings. This is where real disposable income should have taken a dive because people lost their jobs. But instead, real disposable income soared on the three checks that were provided. Arguably, the third one under Biden was not necessary, but Trump certainly provided some liquidity here and again here. And Trump, had he been reelected, was talking about a third round of checks. So we don't have to get political about it. The fact is, the government's there to take care of us, make sure we don't feel too much pain, and they provided all this cash, and it boosted disposable income to the extent that while consumption was initially hard hit by all the people losing jobs, it recovered very quickly. And look at this, we're basically back on the growth trend of consumption. And I don't buy the excess savings because I think the excess savings is what was already kind of spent to boost us. And I think a lot of excess savings is being saved, which means that the savings rate is going to stay down, which means that consumption can grow basically with the trend of disposable income, and disposable income will grow as long as jobs are increasing and wages are increasing faster than prices, which has been the trend for the past year or so, since the beginning of the year. This is average hourly earnings. The good news in Friday's report was, could it possibly be that we could have a strong labor market and still have wage inflation moderating? Then we wouldn't need a recession, which is what the Fed's been talking about, that they need to have the unemployment rate go up. They don't want a recession, but they want the unemployment rate to go up just enough to bring wage inflation down. But here we have the 3-month percent change in average hourly earnings for all workers at 3.3%. And Powell has said that in his opinion, he'd like to see average hourly earnings around 3%, which would be consistent with the Fed's 2% price inflation target. So we're almost there on a 3-month annualized basis. We're not there yet on a year-over-year basis at 4.2, but scaling is everything in this business. I could really show you a much more impressive drop in wage inflation, but it's been dropping. So looking at wage inflation by industries, we've had quite a bit of decline here in the information technology area. Education and healthcare inflation has been moderating. Even leisure and hospitality, they're still up, but they've come down a lot. Financial activity came down, went up, probably going to moderate somewhat. So you can look at it on your own. This time I seem to have left more time than usual for some discussion. So I do have some questions here, and let me see what. Oh, Max is going off somewhere. So let's see what we've got here. Chip. Oh, thank you. Sending prayers to your family in Israel. Thank you, Chip. Brian, same thing. Thank you very much. Joe, first, I hope you're. Thank you. Okay, so everybody, I appreciate your kind words. Why don't we just now? I'll take some questions on the, the the discussion about the markets here. What is your outlook for short-term and long-term bond yields? Good question. Well, you know me, I try to stay optimistic, but at the same time try to be realistic. And I am hoping that a 4.5% to 5% bond yield clears the market. We all know that the bond yield has gone up since the summer from something like 4% to 4.8%. The 30 years has gone up to 5%. I wish I'd listened to Bill Ackman. He made himself a little fortune there in a very short period of time. He nailed it. He said we go to from roughly a little over 4% on the 30-year to 5.5%. So he's nailed it quite well, and deservedly so for the right reasons. Um, a lot of the hedge funds have been very bearish on the bonds, thinking that there's just too much supply. Um, and I think they were alerted to that by the Fitch ratings downgrade of the U.S. debt on August 1st. I've always said that I'm not really going to pay much attention to the deficit until the bond market pays attention to the deficit. We've all known about the concerns that Fitch expressed in their downgrade. We've known about profligate fiscal policy. We've known about these regular government shutdowns or threatened government shutdowns. But the Treasury came in the summer and said they were going to need to raise over $1 trillion in the auctions. I think it was just in the third quarter. So suddenly the supply issue became an issue for the bond market, became an issue for me. And the question is, what's it going to take to clear these auctions, uh, these huge auctions? And I'm thinking 4.5 to 5% should do the trick. If I'm also right, if I'm right, I'm not, because I haven't been right about the bond market. If I'm right about inflation coming down, then I think that will stabilize the bond market at 4.5 to 5% on a short-term basis, and even on a long-term basis. 4.5 to 5% may be the old normal that we're coming back to. Before the great financial crisis, through the great virus crisis, when we had the new abnormal of interest rates at historical lows, or close to historical lows, back prior to that period, the period of the new abnormal, prior to the great financial crisis, the bond yields was in fact 4.5 to 5%. The TIPS yield was 2.5%, and expected inflation was 2.5%. So we're kind of where we should be. The big difference between now and the period prior to the great financial crisis is the deficit, is the sheer size of the amount of debt that has to be financed. I think Janet Yellen recently came out and said, "Don't worry, this will stabilize." But I don't exactly see how that's going to be the case in the short run. So I do worry that we're going to get these auctions where, if they don't go off too well, the conclusion will be that 4.5 to 5% isn't doing it. Then you get the debt crisis phenomenon, which is one that's Ray Dalio has been espousing. And there's a certain validity to it. It's obviously a very pessimistic story, and the idea is that it's going to take something well above 5%, or maybe even just doesn't have to be well above 5%. It could be 5.5%, and that level could be the kind of level that really finally does make the hardlanders happy and cause an economy-wide recession. I think 4.5 to 5% the economy can withstand. It's been resilient in that regard. That doesn't mean we're not going to have troubles in the commercial real estate market. We're going to have problems with zombie companies, but the overall resilience of the economy, I think, will offset those. Hey, I've read the majority of the job increases for last several months is in part-time. True, false? Comments. False. We've actually seen full-time employment rising to a record high, but not in the past couple of months. So maybe it's the past couple of months where how full-time employment has moved sideways. But there's actually two measures of employment: payroll and household. Payroll is what kind of everybody watches, and payroll is the one that counts the number of jobs. So if somebody has two part-time jobs, that counts as two jobs. On the other hand, in the household employment survey, that one person is counted as one employed person, whether they have a part-time job, two part-time jobs, three part-time jobs, or they have one full-time job. That's the way it's counted. So I do look at the household employment data. It tends to be a little bit more volatile month to month. I will say the past couple of months, there's some evidence that household employment has leveled out at a record high, and payroll part-time employment has increased. Let's see. But by the way, that could be consistent with the excess savings. People who've been spending their excess savings obviously aren't big spenders, and maybe they don't need more than a part-time job to make up for excess savings. Maybe there's somebody else in the household that brings in more money. So there's a lot going on in our labor market. Okay, Michael, do you think there will be a shift for goods spending from services spending, given the decline in travel spending and a reversion to the mean on goods spending? Well, I'm not seeing the decline in travel spending. Been relating to you that my wife and I have been doing a lot of traveling, and the airports always seem to be full, and the jets are certainly full. We're going to go down to St. Martin in Thanksgiving, so we're still traveling, and now we're thinking about where we're going to go next year, and we're looking at Portofino. Apparently, it's a really beautiful place to go. So we still have the travel bug, and again, I think I've confessed to you that many years ago I thought I was very special and a unique person, and then I realized there's 75 million carbon copies of me, and the baby boomers were all seem to kind of do the same thing and go through the same things in life. So I'm not convinced that the travel boom is over. Maybe we're seeing some reports from the cruise lines that things are cooling off somewhat, but a lot of cruise um, reservations were made a year, have been made for a year or two ahead. So, and then from my bailiwick, the personal consumption expenditures on airline fares is an all-time record high, and that was in where are we now? That was in September. So that still looks pretty good. But let's say that the so-called revenge travel, I don't know where that term come. I don't know what sense revenge travel. Maybe we couldn't travel for a while, so this is our revenge, and we're traveling a lot now. But maybe let's say that's coming to an end. Look, I think there's room for a continuation of spending on services, particularly what the retiring baby boomers are spending on, like restaurants and airlines and hotels and motels when they go on vacation, or if you're an older dad taking your daughter to a Taylor Swift concert, and your kid convinced you that you should fly out someplace like to Toronto in like next year, which is what my daughter's convinced me I should do. You're going to stay at a hotel and motel, and you're going to fly. So we'll see where Taylor Swift goes next. Maybe that's if you're seeing any signs of a slowdown in air travel, maybe it's because Taylor Swift's going to football games rather than doing concerts. When the concerts start up again, the airlines will be full again, and so will the hotels and motels. I wish I was kidding, but that's the reality of it. But look, the MPMI, the Manufacturing Purchasing Managers Index, the Manufacturing Purchasing Managers Index looks like it's bottoming. So that's a sign that the retailing recession is about over. I'll take one more, and then I've already run over time. Do your year-end targets for equity indexes remain the same? Good question. Yeah, look, I'm obviously disturbed on a personal basis and professionally about what's going on here in the Middle East, and I am probably going to be reflecting that and raising my odds of a recession. Right now they're 25%, but by the end of the day we'll see where they are. But they could be a little higher. But I'm still thinking that the market, the S&P 500, is going to prove resilient like the economy. I think just because I'm concerned about the war between Hamas and Israel becoming a longer term problem in the Middle East and having a longer term impact on the oil market and the whole geopolitical mess that the Middle East tends to be, doesn't mean that the market shares my views. And the market may very well have a view that this too shall pass, will be a ceasefire. And who knows, maybe there will be a ceasefire. I'm no expert on geopolitical matters. I can only opine on them the way we all can if we stay informed. But I'm thinking that the 200-day moving average will hold, or if it gets breached, won't be breached much. And then I'm still thinking that earnings are going to be quite good during this current earnings season. And if the reaction of the bond market that we've seen actually means that we are seeing a some flight to quality in the bond market, anyways. That people are looking at bonds as a good place to be when geopolitical uh, tensions and conflicts escalate. Maybe that'll help at least stabilize the bond market. Then I don't know if we're going to get to 4,600, but I think we'll be moving in that direction. Well, on that optimistic note, thanks all for joining, and I hope you have a good week. Let's do this again next week. All the best.